Hello, everybody. This is John Blank, Zacks Chief Equity Strategist and Economist. Today, I'm going to go through our top picks in 2024 for the consumer discretionary sector. Uh, this has been an exciting area for stock pickers for some time now, and we need to go through with my new system where you can find the biggest and best companies for returns in this space. So, part one, we will go through the top picks in consumer discretionary by market capitalization. Very critical to know the big names that own the big landscape in this space. Part two, what is interesting to Wall Street? We'll get into the top picks by the number of analysts covered by the stock. Part three, we'll get into the Zacks Rank way to do it, largest 1 month percent change in current fiscal year estimates for earnings. You'll find out that a lot of names, under the radar names, small names, and underappreciated names end up in this bucket. It's kind of interesting to go through my 3-part piece because you're going to find a little bit of something of interest in each of these sectors. So keep this in mind. Now, of course, these are the disclosures. These are my views, not necessarily the views of Zacks Investment Research. All right, top names in the consumer discretionary sector. I've got this by ticker, company name, market capitalization, and of course, industry name and sector. So industry and name and sectors over here. Of course, this is the consumer discretionary sector. We've got 6 groups of industries: apparel, a very important sector, the largest market cap company, LMVH Moët Hennessy in Europe, known as one of the granolas, that's like the Mag 7 in the United States. This is a very critical company. LVMUY leads the way, but there are other big companies in here. Nike is a big one. Lululemon is a big one. And down here, a smaller one is Under Armour. Over here, you're going to find Savers Value Village. This is a secondhand store concept that's based in Bellevue, Washington. You probably don't know about it. So again, here we find something you didn't know. Here you find the biggest company in Europe, and down here you find a lot of interest in names like Nike, Lululemon, and Under Armour. So apparel, home furnishing, appliances, these tend to be smaller companies. We only got a couple here. Will Scott Mobile is a temporary mobile home provider, temp space type thing, and Shark Ninja, which is an interesting company in the Boston area that makes super neat appliances. Leisure services. So this is your Marriott. Oriental Land, you probably do not know. Ticker OLCLY. This is a leisure and tourism subsidiary of a railway company in Japan. It owns Tokyo Disney. So it's theme parks, hotels, and other businesses. Now, what you're going to see here is Oriental Land, Sony, Nintendo, Panasonic, Toshiba, and over here in Sharp are all getting up onto the consumer discretionary sector by market capitalization, particularly. As you know, the Japanese stock market is at record highs, haven't seen it in 35 years, and they're fighting their way into this space. Here's all those names other than Sharp, which is still not recovering from its problems with its business model. The others are doing quite well. Sony, Nintendo, Panasonic, Toshiba, and of course, this name you probably don't know, Oriental Land Company. So, like you can see here, by market capitalization, we're going to have actually the best names in this space. Over here, it's kind of interesting to see some new names, but it ends up being a very, very noisy space. We'll talk a little bit about Naspers. This is a big media group down in South Africa. You probably do not know, but it is very big, 32 billion in market cap. Trip.com is basically like a TripAdvisor thing in China. We'll see other big names in China, and we'll get into them and talk about them. So here is the setup by market capitalization, of course. That's all right here. By the number of analysts covering stocks, which is a little wider spread, but none of the small names because they just don't get coverage here. And over here, you have lots of small names when we do it by analyst estimates. Some of them, though, can be quite big. Trip and Naspers, Liberty Media are the 3 big names that end up over here. Sharp, 3 billion in market cap versus, say, let's take a Panasonic, which is 22 billion. All share price related there. So on we go. dividend adjusted price total return performances for the last 15 years. So, of course, up here we've got market capitalization. Here we've got by the number of analysts covering the stock. And here we've got by the first month of change in first forward estimates of earnings. So up here, who's the best one? The best name to own the last 15 years was, to no surprise to any of you, Netflix. 11,000% return. Just crazy. There's a lot of other great names here. Nike did quite well. Comcast, surprisingly, 760% returns. And there is your LVMUY, the big luxury supplier, Disney and Sony. So over here, lots of big names and lots of performance. That has been the story here. Really want to focus on if these names can continue. They've kind of gone sideways since the COVID pandemic. They certainly did well until this point in time, and you can see Netflix is recovering. Others like Nike, not so much. Comcast, not so much. Lululemon has been extremely strong, both before COVID and after. That's the yoga supplier based up in Vancouver. Marriott, huge name, and you'll see that a lot. Marriott did the 2,000% return. Oriental Land, which we talked about, didn't do much. 200% return over 15 years. That's not much at all. Take-Two Interactive. This is a game supplier. Very well covered. People like the game businesses and DraftKings. You can see Roblox. The three big names here that covered a lot are in that gaming space, and Take-Two has been the best. However, look at DraftKings coming back and not as long a chart pattern. So it's really just because DraftKings is a newer company. Over here, you got Under Armour that really peaked in 2015 and has been selling off since that time. And Paramount, of course, has been kind of an underperformer, and they're struggling to find their business model in the new world. Over here, we've got Naspers, ticker NPSNY. Now, as I explained to you, this is a paid television, internet subscriber, print media, book, private education, and tech. It's everything at leisure and consumer discretionary. It's down in South Africa. That's why you don't know it. But it did 1,700% returns as it grew its business over the last 15 years. Flex Steel is a furniture supplier, appliance furniture supplier, mostly furniture. Flex Steel, of course, think about the name. Building types of furniture that people like. Sold off big into the COVID pandemic, but has been recovering of late. Interesting to note that. Okay, so that's our broad overview. Like I said, you're going to come back here to these names and the tickers and the industries in the sector. You're going to come here for the dividend, you're going to press the price, and now we will dive in. First, to the top picks by market capitalization. All right, number one, like I said, is market capitalization. Here is revenue, here is earnings, and here is free cash flow. So, forward 12-month revenue, the best is Disney. Mark it down, Disney. Over here, we've got Marriott. This is the incredible story of the rise of the leisure businesses after COVID. Actually, picking up where it left off from 2016, it bought Starwood here. Talk about a little bit when it acquired the debt to do that. Marriott, though, has been a big growth story and a big stock. Keep this one in mind. Netflix, of course, is doing quite well with earnings. Look at that chart. There is your Mag 7 story. Marriott, though, don't overlook it. It came up here in revenue, and now it came up here in earnings once again. And down here, once more, Marriott free cash flow. A trifecta for Marriott. There's a name for you. LVMUY, the luxury supplier in Europe. Look at this thing. It takes off over 2017 and on. So it precedes this rise. I expect this is a lot of it. It's Asia, Chinese luxury goods supplying, both people coming to Europe and people buying it in Asia. And so you've got all the names that are really worth looking at here by market capitalization. Return to this. Look at these names. Top picks. All right. Return on equity. Of course, we care about this. Who's got the best? Nike, Netflix, LVMUY, Sony, Panasonic, Disney, and Toshiba is negative. So Disney and Toshiba are kind of negative. Everything else here, pretty solid. These are the best ones, of course. The best names are Nike, Netflix, and LVMUY. Over here, you've got a few more names. SN and WSC, Electronic Arts are the ones you like. Nintendo actually looks pretty good. It has been also recovering from that 2017 period onward. Down here, we've got earnings pureness. Not a lot to learn here. They're all basically around 100 or they're kind of bouncing around. Let's skip that one. But down here, we got capital expenditure. Theme parks, Disney, a big player here. Sony, actually, as you can see, has been rebuilding their businesses in the last few years. Sony comes up here, and it does decently, not great, with return on equity here. Oh, I'll see, that's the Olympic Land. So over here, you've got Olympic Land. That is the Disney in Japan, the theme parks and other things. Olympic Land, kind of a combined thing of hotels and theme parks and so on. Okay, depreciation, total debt, and reinvestment rate. Now, first of all, I want to point out here, of course, we had Disney that acquired 21st Century Fox in 2019, so it jacked its debt up. It acquired using debt. And then we got Marriott and Starwood, which is over here. That happened a little earlier in the 2016 period. So really what happened here, Marriott got in front, grew their business, and then had a really strong performance. So got to think the corporate strategy at Marriott back to 2016 was extremely well thought out. That one worked. Disney, 20th Century Fox, yet to see this one work. Well, of course, much newer acquisition, but a more questionable one here versus this one. Of course, who's the big name here that's sticking out? Netflix, of course. And down here, we're seeing them again, Netflix. Now, keep in mind, capital will be used to debt in low interest environments. Of course, these were in the pre-COVID low interest environments where Disney and Marriott did the acquisitions. And now we're not seeing that, and we're seeing equity might be issued because it does not need to be paid back. So at some point, you would think with high stock prices that people will start issuing equity, taking advantage of that. Okay, now our valuations. But keep in mind the S&P 500 for 12-month PE right now is 18. So we're looking at some growth names if it's above 18. And basically, we see a lot. Nike at 26, LVMUI at 26, Toshiba at 23, Disney actually at 22. Seeing it as a growth stock. Marriott, as we talked about, one of the top names at 26. WillScot Mobile down there in 20, just above that average. So it's doing okay too. Down here, you're going to get some names that are undervalued, like Panasonic. Sony actually is probably maybe overvalued at this point in time. And Olympic Land, you're saying it's just kind of crazy. The valuations here, I wouldn't trust that at all. Onward and upward, look into these things. Keep in mind, valuations can be quite different in some parts of the world where we don't have a lot of analyst coverage. All right, now let's get to analyst coverage. Obviously, we want to see if Wall Street really cares about a stock. Doesn't have coverage. It's probably not one that the investors on the buy side will be looking into very much. So keep that in mind. That's our pick here to find out what the Wall Street analysts are covering for the buy side. All right, top pick, Lululemon. Return on capital is excellent at 41, 45 almost. Crazy good. Nike, quite good. Here you got Hyatt, which is a competitor of Marriott, actually doing better and better, but just not as big. DraftKings and Roblox is actually negative. Still growing the company, but not making money here. Over here, you've got another bunch of names, Paramount, Comcast, and Sony. Take-Two comes over here. So return on capital, of course, you just want it to be better. And these are the best names right here. Price to sales. Keep in mind the price to sales average is 2.7. So anything above 2.7 here will be a growth name. That will be Nike, Lulu, Roblox, and DraftKings. And over here, Take-Two. That's the interesting thing here. Down here, of course, we've got earnings yield. And actually, you can see that Under Armour is actually underappreciated as an earnings yield perspective, as well as Comcast. So here are two names, Under Armour and Comcast, that come out in an earnings yields perspective, probably undervalued. People obviously don't trust the linear cable businesses anymore. They don't think Under Armour has the right model for this environment like Lulu. But there you go. You've got some undervalued value opportunities, perhaps, in this space. All right, net margins, total debt to capital, CapEx to depreciation. Of course, net margins better than most. Once again, Lululemon, Nike, Hyatt, Under Armour comes out again, by the way. And then we've got Comcast, Sony, Sonos, which is actually here in Santa Barbara, but is negative on their net margins. Not a great showing here. These are only the names we want, so we'd like to stay with Sony and Comcast and the rest. Okay, Roblox again, total debt, a lot of it here. Peloton, in trouble as we know. So these two names are growth names that have piled up a lot of debt and it would be worrisome for an investor. All right, price, EPS, and surprise charts. These are the ones that we really care about. This encapsulates all of what we've learned today. So what do we like? DraftKings is doing well. However, notice that these are negative numbers, so it's just turning positive on DraftKings. Lululemon, 6 to 16, just an incredible name, incredible stock. Gotta like that stock still. Look at that chart. That's beautiful. All right, Hyatt actually doing quite well. A little closer pattern, not as quite as growthy, but a very strong name to own and a very, very successful company. Under Armour, of course, has peaked and is very sold down to $8 a share, but actually doing okay with the earnings. Again, undervalued stock. Roblox, people loved it in COVID. Now it's basically not playing out very well. All right, here's Comcast, another nice chart. Here's Take-Two, pretty good chart. Again, you're seeing that growth that way. And here's the story of Sonos. They must have had a really good fix last year, got their earnings back into the positive direction. Might be a buyer here for that one. Peloton, they're getting the business turned around. At least they're not losing money as much, but that is a negative sign. You don't want to deal with this stock. Sony, questionable why this one. And Paramount are doing well. These are questionable names. You guys look at Paramount, that's classic, but you do not. All right, now let's get on to the largest 1 month change. These are kind of crazy names. Overlook on this space because of the nature of things. These big companies own the consumer discretionary space at this point in time. All right, EBIT, Sharp is up here. And Trip.com, that's a Chinese name and that is Japanese name. So first two names that come to play here, Sharp and Trip. I put Trip in red and Sharp in yellow, and you can see they're really the only two names that come up from an earnings, liabilities, and quick ratio perspective in any good fashion. Quick ratio is kind of low because they just don't have much money here. But Trip.com is probably not a name you know, so keep it in mind. TCOM, SHCAY for some of those who are looking for a penny stock or dollar stock. Gross margins, QSG, let's talk about it. Quantasing Group Limited, an online service provider in China, adult personal interest learning, personal interest courses. So like think about a LinkedIn learning kind of thing. Great gross margins, 80%. They just keep selling those online courses to more and more people. AGS we'll get into is a casino gaming supplier, and it has also got really high gross margins. So there's your two names that I have found are good here. But again, I want to talk about play AGS. Here you see it from a free cash flow net input perspective. Here you see it from an enterprise value perspective. Here you see it from a price tangible book perspective. This is a designer and supplier of electronic gaming machines for those casinos in Vegas and, of course, the Native American ones. It is headquartered in Vegas. That's another story in the leisure space you may not know about. AGS. Price to free cash flow. Again, here's all our names: Sharp, Flex Steel, Tripcom, AGS. These are the names that we've been talking about. So here they are again, and here they are again. So keep in mind, when you get in this space, you're going to find names you probably do not know about. All right, that's it for me. I hope you enjoyed it today. I kept it moving quick. Like I said, this is Consumer Discretionary. These big spaces by market cap and covering analyst coverage are probably most interest you, but don't neglect learning something from these faster moving names that are under the radar out in this space. If you like these slides, give us a call, 866-794-6065, or give us an email, strategycall@zackspro.com, or find us on the web at www.zackspro.com. Like I said, you got to get the slides from us. Hold on a little bit here. 866-794-6065. Thanks, everybody.